look at this Excel spreadsheet. Now, this Excel spreadsheet has formula embedded in some of the cells. So really all you have to do is to key in pretty much these numbers. Okay, so first of all, the price, what the contract price is. And in terms of the stamp duty, as you know, this is made up of two components, being the stamp duty that everybody has to pay, as well as if you're a foreigner, there is a foreign surcharge as well. Okay. Rates, in this case, we are combining the water rates and the council rates. So council rates generally, for the instance of apartment, in this case, is about $1,500 a year. Water rates is about $600 a year. Okay, so we're talking about an apartment here, using 1401 as the example. 1401 has a contract price of $459,600. Stamp duty surcharge 7%. The stamp duty itself is probably about something like 14,000. And the council rate is 1,500 plus 600 per year, so 2,100 a year. Owners corporation, this is the fee that you pay to the building manager to maintain the building and put the security in place, do the cleanups of the public areas, so on and so forth. So that's about $3,700 a year. Furnishing, that's to put the furniture, that's to buy all the new furniture into the apartment so that the tenants can move in straight away and live. And usually tenants would pay a little bit more for that. So in this case, the deal that we've negotiated with the developer is so that the developer, as the seller, is paying the stamp duty, okay, or way of rebates, as well as furnishing, and also the legal cost. The legal cost here is something that the buyer should be paying to their own solicitors, but in this case, as an incentive, the developer is paying it in terms of a rebate up to $2,000. So these, the ones in green are the ones that are ongoing cost. So the council rates, water rates, the owner's corp per year, and also the insurance. We're looking at about close to $1,000 a year in terms of insurance, contents insurance, fire, theft, and things like that. Okay, and the orange are the one-off cost. Okay, so you only pay the legal fee once, the furnish once, and the stamp duty once. LVR, if you recall, it's the loan value ratio. This is how much as a percentage proportional to the property price that you can borrow from the bank. So in this case, let's say, for example, it's 70%. Okay, so that means you can borrow 70% of $459,600 if that price comes at a valuation price by the bank. And let's say the interest rate here it's 5%. Okay, so you're paying 5% interest on the principal, and the principal is 70% loan of the contract price. Okay, so the interest per year, you can probably see in the calculation here, it's the contract price times 70%, that's the principal, times the 5% interest rate. Okay, so that gives you $16,000 to be paid per year as interest. If you recall from our earlier conversation, our previous module, in Australia there is a way to pay interest only to the bank, so that you don't necessarily have to pay the principal until a certain date. And this is definitely one of the things that we highly encourage all investors to consider, because if you're not paying the principal over the years until a certain date, if all you're paying is the interest, then it works out that your return on investment is a lot higher. Okay, so the least you pay, the more you get paid, the better. Okay, so in this case, we've got all this cost, and for the first year, so this is the year 1, year 2, year 3, all the way to year 5. So if we assume it's going to be an investment period of, say, 5 years, then your first year, your expense is going to be consisting of the stamp duty, the rates, and all those ongoing costs, as well as the one-off cost. Okay, so your first year is going to be fairly high in terms of your expense. Okay, but the developer will pay for the bulk of it. Okay, so the developer will pay for the legal, the furnishing, and the stamp duty and the surcharge. And so the net expense is your total expense minus what the developer pays for you. Okay, so that's your total expense out of your pocket. Okay, so your total outgoing is basically the sum of all these expenses. Right. Now, if you recall from our previous session, in terms of paying the deposit, so in order to start the transaction, you pay a 10% deposit, okay, based on the property price. So 10% of 459,600 is 45,960. Okay, that's the deposit that you pay. And if we are borrowing 70% from the bank, it means that we need to come up with another 30%. So in this case, 30% is the down payment, okay, which is the contract price times 30%. Okay, so this actually includes the 10% deposit. Okay, so this is the amount that you have to pay out of your own pocket, okay, as an investment. For an apartment that we using here as an example, a one bed, one bath, one car park apartment, let's say 1401 from St Paul's Tower, is 459,600. We would expect the rental per week to be about $450 per week, and the vacancy rate is generally sort of 1 or 2%. So you're looking at about perhaps 3 or 4, 5 days empty of the year. So that's very good occupancy rate. And therefore, for $450 per week, if you times this number by 52 weeks in the year, you would get 23,400 in terms of your rental income. Okay. Now, the rental income doesn't just stay the same every year. Usually, as part of the tenancy agreements, the rental increase on a year-by-year basis is 3%. Okay, so your first year is going to be 450 times 52 weeks, and your second year is going to be your first year times 1.03, or in other words, your first year plus another 3% of it. Okay, and your third year is going to be the second year times 1.03. So the second year plus another 3%, and then so on and so forth. And so your fifth year, your rental income would be 3% higher than your fourth year. Okay, I'm sure you get the idea. So this is what we call compound growth in terms of rental income, which is quite powerful. Okay, because by the time that you reach year 5, this would be you'd be looking at about $3,000 more in that year than what you've received in your first year. And so here we've also calculated a cumulative rent. So your first year you've received 23,400. Second year you've received 23,400 plus 24,000. So that's your rental income for the second year, so on and so forth. And so by the fifth year, you would have collected close to 124,000 in terms of your cumulative rent of income. Now, profit. What's profit in this case? Well, it's basically what your income is minus what your net expense. Okay, so your income in rent is 450 times 52 weeks. Okay, so 450 a week, 52 weeks, that's your income, and that's your net expense. You take away that from that, you get $514 in profit. Okay, and if we do that to every year, you realize that by the third year, you would have got about $3,400 in terms of profit by taking away the net expense from the rental income. Now, we're going to be making a few assumptions here, obviously. So the first assumption is we are going to assume that we are doing our calculations based on 70% LVR, so 70% loan-to-value ratio. And the second assumption is going to be based on a 5% interest rate. Now, usually interest rate can be fixed or it can be variable. So if it's fixed interest rate at 5%, then this would all make sense. But usually what we encourage is to have a variable interest. And so that means if you recall from our last module, the RBA, the Reserve Bank of Australia, if RBA drops the cash rate, then all banks would reduce the interest rate and therefore your interest rate here would go down. So this is actually prone to fluctuation, okay? And we use a rather optimistic figure of 5%. Okay, usually it can be. We use a rather pessimistic figure for this space here, so 5%. So usually it would be somewhere between 3 to 6%. Okay, so just for ease of calculation, we use 5% here, right? And we also assume there's going to be 3% rental increase, which is usually the case. Okay, and $450 per week. So these are the assumptions that we have that we use in this calculation. Okay, just as a demonstration purpose only. Now, that's the profit. So you'll be basically making profit every year after you buy this apartment. Okay, and that's the ideal case we want. Gross rental return, in this case, the way we calculate it is your return, which is basically the rental income divided by your contract price. Okay, so that's what we call gross rental return. If this number is beyond 4% in Australia, it's considered very good. Okay, so generally, as you can see here, it's more than 5% since the purchase of the apartment. Okay, the expected growth per year. Now, just like the rental income, it doesn't stay the same. There is a growth in every year. We'd also assume that there is going to be a capital growth on the property every year as it grows. Okay, so if you recall from our previous module, Australian property would double in value every 5 to 10 years. Okay, so if we use a rather conservative figure here of 4% growth per year, then this is the amount, literally in dollar terms, that your first year this property has grown. Okay, so 4% times your the purchase price. Okay, and similarly, here is the second year expected growth is 4% of what the expected value of the first year would be. Okay, so this is how much it grows in the first year. This is the end result of what the apartment would be worth after the first year, after applying your expected growth. Okay, again, you're using compound growth here. So every year you can see the expected value of the apartment would grow. Okay, so by the time you reach fifth year, we would expect the value of the apartment to be close to $560,000. Okay, which would be about $100,000 more than the actual contract price that we bought at 5 years ago. Okay, again, using compound growth of 4% year on year. The total net gain per year, in this case, we're simply adding the expected growth, or in other words, the capital gain that we made in that year for the property, and the profit. So the profit in this case is cash flow, whereas the expected growth in this case is the growth on equity. Okay, so the total gain per year, as you can see, is a positive number, and that's very important throughout the year, so throughout every year of your investment cycle, investment period. The net return on investment then becomes your total gain divided by your total investment. Now remember, this is actually the contract price, but we didn't actually end up paying that, right? We borrowed 70% from the bank, and our expense by borrowing the money from the bank is the interest, okay, which is calculated in our net expense. And it appears that all our net expense is actually covered by our rental income, plus furthermore, we make a profit. Okay, so which means really the out-of-pocket cost for us is that 30% down payment, okay, which is something that we have to pay in addition to getting that 70% loan. So this becomes really our investment. Okay, and therefore our total gain divided by our investment would be our net return on investment. Okay, and we do that for every single year. Okay, your total gain for your third year divided by your investment. Now, your investment doesn't change here, obviously. Okay, so that's the 30% of the contract price of the property. Okay, and by the fifth year, your total gain would be close to $25,000. Okay, that divided by your investment will give you 18%. Okay, so every year throughout the 5 years, you would get somewhere between 13.7% to about 18.1%. Now, that return on investment net is very good. Okay, now we also want to consider if you want to sell the apartment after year 1, year 2, year 3, year 5, what would be the margin? Okay, again, so the way we calculate this is based on the expected value. okay, after applying the 4% growth compound per year. So let's say if you want to sell after 5 years, the fifth year, your expected value would be close to 560,000. That takes away the 450,000 that you initially bought the apartment, would give you about 100,000. Okay, that's the profit margin that you would make. Okay, so this is the table that we use pretty much every single time, and it's pretty precise. Now, there's a few sums for us to go over. So based on 5-year investment period, if we have all those net expenses, right, we add them up, it would give our total expense to be about 114,400. And similarly, if we add up all the rental income for the 5 years, we get 124,230. Okay, so this is our total income for the 5 years. This is our total expense for the 5 years. And our total gain for the 5 years is simply, if we sell it after 5 years, this is our margin, okay, plus the total return minus the total expense. Okay, so the total rental income minus the total expense basically becomes our total cash flow, and that add up to the margin made gives us the total gain that we've made after the 5-year investment period. Okay, and if we divide the total gain, okay, if we divide the total gain by the down payment, in other case our investments of 30% of the purchase price, it would give us 79.3% of the overall ROI. So ROI stands for return on investment. Okay, so after 5 years, if we sell this apartment, the profit margin that we make plus the cash flow that we make together would give us close to 80% overall return on investment. Okay, so that's for the 5 years. Now, if we average this number over the 5 years, it would be something like 16% return on investment every year. Okay, which is a huge return on investment. And if you recall that we have this sort of investment analysis report left blank, if we simply copy and paste the numbers from the Excel spreadsheet into here, we would have got basically an investment report. Okay, so again, going through this, if we recall the numbers from Excel spreadsheet, apartment 1401, 459,600. Let's say we invest for 5 years. We borrow 70% from the bank, paying the bank 5% interest per annum, interest only. The expenses will be about 14,500 for stamp duty, 7% of the purchase price being the surcharge for foreigners. So if you are an Australian citizen, you don't have to pay this. Legal fees of 2,000. Bank fees of 1,500, so that's including the valuation fees, the risk fees, line fees, etc., etc. Plus probably every month you'll have your account fees as well. Okay, furnishing 5,000. Right, so these ones are the ones with asterisk are the ones to be paid by the developer as an incentive to help you with your calculation and your profit. And that's the ongoing cost. Right, the annual cost would be the land tax. Okay, that's the rough calculation of the land tax on the $459,000 apartment. The owner's corp, 3,800 or 3,700. It could go up and down. Council rates and sewer fees, or council rates and water rates. These together would be about 2,100 per year. Insurance, 1,000 a year, and the interest pay would be about 16,000 a year. Okay, so if you add them all up, the total expense for the 5 years would be 114,000. Your total investment, if you remember, was the 30% down payment. Okay, your total income for the 5 years, you saw earlier in the sum of the total income, 124,000, and the sales margin, if you sell after 5 years, is close to 100,000. Okay, so your total income minus the total expenses in this case is the total income, 124,000, minus the total expense for the 5 years, it will give you 9,300. The rental divided by the property price, so this is the gross rental return, okay, of 23,400. If you divide that by the original price, would give you 4.1% roughly, and that would increase itself by about 3% per year. 4% per year in terms of sorry, this 4% is actually the capital growth, but the rental yield increases by 3%. So if you apply that 3% rental yield every year growth, then you would get a higher percentage in the fifth year. Okay, and if you add the profits, so that's the cash flow, plus the growth per year, and you divide it by the total expense, okay, that's your return on your investment. That would be about 13.6 or about 18.1% per year. And if you calculate the total of your sales margin after you sell for 5 years and all your profit cash flow for the 5 years and divide it by your total investment, which is this number, you would get about close to 80%, as we saw earlier. So this is how we would generate an investment report for ourselves, okay, after working out all those numbers from the Excel spreadsheet. Okay, so a little bit more about our own services, what we can do for clients, whether they're Australia or they're overseas. So the first thing is we would do investment analysis for our purchasers, for our investors, similarly to what you just saw, okay, but in more details. We would have legal and accounting specialists in Australia, accredited in Australia, that you can rely on. And these people can establish the right structure for your investment for both asset protection as well as tax optimization. Okay. We can also liaise with the best brokers as well as the banks, lenders, to source the best loan solutions, the lowest interest rates, and possibly the highest LVR for you to maximize your leverage. And in terms of property management, this is when we find and select the most suitable tenants and to make sure that the rents are paid on time and property is well maintained with regular reports produced to you. Okay, so in the case of if you need long-term tenants, it would be something like $450 per week, as you saw. But if you want higher rent, then it might be that Airbnb or the types of short-term stays might be possible, which we can also manage for you. Okay, so there are different options depending on what you want. Apart from renting, there is also the resale option. So when you decide that you want to get out of the property, cash out, sell the property, get a profit, we can also select the buyer or maybe even source out the right agents to sell the property for you at the highest price in order to maximize your sales margin. Okay, so these are the different things, the 5 things that we can do to remove the hassles from your end so that you can get the cash flow and the sales margin at the end, make it a worthwhile investment. So there are different steps to the property sales or the property transaction in this case. So what we've done just then is basically presenting to clients in terms of investment analysis, the project. We help the clients to select the units. So when you're about to make up your mind that you want to purchase, the next thing is that we want to make a reservation. So generally, the client will fill in the reservation form, pay anywhere between 1,000 Australian dollars to 5,000 Australian dollars or 10,000 Australian dollars, depending on what the price is for the actual apartment or for the property. You pay that fee to the designated account, and that's usually our trust account or the developer's lawyer's trust account, and then the client also to confirm on the timing and the in terms of for this particular property that you're trying to purchase, how long would you want the settlement period to be, and what structure are you trying to invest? Whether it's investing under your own name, which is something that we highly do not recommend, or as a company or as a trust. Okay. So after reservation, the developer then or has its lawyer produce the contract for you, which says what number, what lot that the buyer is trying to purchase, who the buyer is, who the seller is, and what are the different terms, and all that sort of things. Okay, so the contract is pretty comprehensive. The buyer and then the solicitor will review and advise before signing. That's the second step. The third step is basically the signing of the contract. In Australia, a few years ago, we still couldn't do electronic signing, but now we can. Okay, back in probably 2010, a lot of the contracts have to be printed signed by hand and scanned back, which is rather not necessary. In this case, now we can do electronic signing, so you can use a PDF editing software to put your signature there, and that can be done. And the client signs the contract of sale, then the seller or the developer signs it. Now, you may recall from our earlier conversation that we have a 3-day or a 5-day cooling off period, depending on different state, okay, 3, 4, 5 days, which means that during those 3 to 5 days, the buyer can regret and basically pull out of the contract, but there is usually a 0.2% or a $200 fee, whichever is greater, as a compensation to the other party. Okay, so there is an option. So after this cooling off period, then both parties are then legally bound by the contract. No one can pull out unless if the buyer wants to pull out, then the 10% deposit needs to be sort of paid and not refunded to the developer. Okay, sometimes the developer is lenient, so after the signing of the contract, you would then pay the 10% deposit. Okay, so this is paid to the developer's lawyer's trust account. As we said previously, it's monitored by the government. The developer will not access this money until the final settlement of the property, unless in the contract the buyer specifically tells the developer that the developer can access the money. Okay, usually that's not the case. So after this deposit is paid and after the cooling off period, if the buyer wants to pull out, if the developer is lenient enough to refund the 10% deposit, great. If not, then literally the buyer would lose that 10% deposit. Okay, so it's best to really think about this deal before you really pay the 10% deposit. Loan application. So this is after paying the deposit. We're now in the contract. The buyer and seller are now legally bound by the contract. Then the client, the buyer, will need to submit documents to the lenders or the banks and apply for property loan. Okay, so in this case, the documents include ID, for example, passports, driver's license, citizenship card, Medicare card, things like that. And then there will be also things like bank statements, etc., employment letters, and other things that can prove the income. Okay, so basically banks would care about the serviceability that a buyer can have to make sure that the interest can be paid. Okay, so in this case, the client can verify the ID and open up a bank account. So there are different banks in Australia that you can use to open up a bank account without physically coming to Australia. Then if you're all successful with the loan application, the lender will then approve the loan and release the loan to the developer, okay, on behalf of the buyer, using the property as the security. Okay, in that case, we'll be basically ready to settle. Okay, and settlements basically after the loan gets released to, or the loan principal gets released to the developer, the buyer then would have to pay a stamp duty to the government. Okay, so if you're a foreigner, in this case, you have to pay the stamp duty plus the surcharge to the state government, and then the state government will do the transfer of title. So the stamp duty is exactly what it says, stamp, right? The government put a stamp on a piece of paper that says, yep, the government verifies that this property now belongs to the buyer, and it gets transferred from the seller, the title. Okay, so the transfer of title, after the stamp duty gets paid, the government then does the transfer of title, which is the stamp, and then this property would become officially yours, becomes officially something that belongs to the buyer. Okay, and then what we do as part of our concierge service is we can help you lease it out, furnish it as soon as possible to help you start earning the rent as an Australian property landlord. Okay, and that basically concludes the transaction. So in this module, what we've covered is basically the entire property transaction. Okay, and the first and foremost thing is how to help clients set up the right structures. Okay, that's to do with the client's own circumstances, to do with their asset protection as well as tax optimization. Also, there are different services that we cover, and we've also covered basically the entire process of a property transaction from start to hopefully never finish.